I'm Mary Vandenack, founder and managing partner at Vandenack Weaver, and I will be your host as we talk to some experts from around the country about closely held businesses, tax, trust, and estates. On today's episode, I have Mike Weaver. He's also a managing partner here at the firm with me, and Rob Wellendorf, who has devoted a lot of his career to business exit planning. He's an expert in this topic, and he's president at Executive Wealth Strategies. So welcome, Rob and Mike.
Thank you.
Thank you, Mary. Rob, good to see you.
Likewise.
So when somebody's considering a business exit, so we're not talking about succession planning so much as we're talking about an exit, like Rob, what's the kind of first thing that they should think about?
Okay, great question. And that first step oftentimes is a difficult one. I like to ask the business owner to somewhat look through the windshield and describe how they see the next period of time, however they want to define that. I think it's extremely important to have that owner truly visualize the next 6 months, year, 2 years, 3 years, perhaps generally before we get more specific.
And when you say that, does that mean what are you going to do after you sell the business, or what are you going to do before you sell it?
Sure. It seems like for the owner exit, there's two main aspects that need to be lined up. The most obvious is the financial. So we do need to spend time as we look through the windshield, having the business owner describe what their lifestyle might look like, not only now, but into the future, because of course there's going to be a financial aspect to that. What kind of money, amount of money is it going to take to fuel or fund that lifestyle? And oftentimes they want it to be very similar to what they've had in the past. The other aspect, Mary, is really the emotional. Thinking about, oh gosh, as a business owner, as I am, I've provided incredible impact in my area, purpose, routine, those three, for examples, purpose, impact, routine. What will that look like for the owner at a time they no longer own the business?
And that's a rather significant issue. But my question there, so I have a brother who is also involved in doing a lot of business exit planning. And he says there's a lot of heartache on business owners before they sell, but a lot of times they're really happy afterwards. Is that your experience, or is that just the particular owners he might be working with?
I think where most of the pain comes from is with surprises. So I think about, in working with the other advisors and the owner and the family, trying to better understand financially and emotionally what's important to them so that we can plan accordingly and eliminate or at least reduce surprises. The question, and you make a great point, if on Friday I'm running a successful manufacturing firm with 450 employees, and the following Wednesday, I'm just strolling through Target aisle 7. I think the owner should be really visualizing and thinking about what life might look like when they're no longer going into that particular office.
So, Mike, let's say they've kind of considered that, and Rob's got them on a good strategy for that post-exit plan. Sometimes it's finding a new business, right, Rob? That's what we see some owners do. And last year I tell people, like, the prices we were seeing for selling businesses, yeah, just sell and you can buy all the businesses you want. But so, Mike, let's say from a technical perspective, what would be like step one in looking at the company's, say, tax structure or organizational structure in terms of getting them in the best position to exit, and looking at, since we want to make sure is they get the best financial value out of the business. What do you look at that point in time?
Well, that's an excellent question, and one of the first things that you need to look at is really just, what is your capital structure? How complicated is it? How difficult is it going to be to find a buyer based on your capital structure? So you may look at your capital structure and you may have voting stock, you may have non-voting stock, you may have preferred stock, and those have different liabilities or obligations associated with them. You may have a stock ownership plan with your employees where they either have outstanding options to purchase stock, or they have purchased the stock outright, or a combination where they own some outright and some may still be vesting. So when you're going to sell your business, and particularly if you're doing a transaction where you're selling the stock of the business, how is that the structure of your capital going to impact a buyer's ability to get what they want? So I think you need to look at that and just ask yourself, is this a structure that's going to make sense to another buyer, or do I need to kind of clean it up a little bit? And I think a lot of times what an owner will do is, particularly with option plans, clean that up a little bit, take care of those employees now, do something with them now, either cash them out or specifically address, how they are going to be handled in the transaction. So that type of analysis, I think, is important from the get-go. Another thing you need
let me ask you a question on that. Well, and it's kind of a slightly different one. So some businesses that we work with, like I just helped a client through an IPO, but the buyer only wanted to buy a specific portion of their business. So as part of that, visiting the structure of the company, does that also involve taking a look at different lines of business and saying this, these might be sellable to different markets as opposed to the business as a whole? And there's some small businesses that, hey, they just sell French fries. But I had a company that was involved in cryptocurrency and cloud computing, and I don't remember, but 3 or 4 other lines. So they divided that business structurally. Is that something that is typical to look at?
Yeah, that was one of the next things that you're going to want to do is just that. Look at your business or businesses and determine, is it feasible to sell it as a whole, or is it more feasible to sort of divide and conquer, so to speak? So you may take an example, in your example, your cryptocurrency business and your cloud computing, and you may say, I've been operating those as one because I'm really good at doing all that. But a buyer may not be interested in your cloud computing. They may only want your cryptocurrency or vice versa. So can you, prior to the sale, structure your business so that it's easy for the buyer to buy just what they want? Can you take that line of business, drop it into a subsidiary, spin it off to yourself or other owners, prior to the sale transaction? So that's definitely a step that you want to take, is just take a look at your physical business, your lines of business, and does it make sense to sort of divide those up?
So Rob, do you have any different or additional thoughts on looking at the structure?
I think those are great points. If you think about the business owner, as I said, looking through the windshield and figuring out what life might look like, what Mike had described, perhaps that could be the owner's decision to separate out a particular company, entity, or line if the owner was not willing to completely be done at that time. So perhaps the potential buyer is saying, I only want this piece of the business and not that. However, I also want to encourage potentially the seller to think in that way as well, if he or she is not entirely ready to be done. A way to create some, a capital event, liquidity event, without totally surrendering this business ownership. Or Mary, as you said earlier, oftentimes an owner will sell and then buy again.
And Mike, so one of the things that we always have to take a look at when we're helping a client look at business exit planning is the status of their financial statements. Now, some businesses are already complying with GAAP, but if you have a company that's, say, not subject to the GAAP rules currently, say you have a smaller closely held business, or it might be a big closely held business, right? And they've been buying jets for the owners or Maseratis or whatever, and those are on the expense sheets or something. Is there some work that you should do in preparing the financial statements? And maybe not really those examples, but as a generality, what should you think about in terms of how the financials appear as you're moving into presenting those financials to sellers?
Yeah, that can often be an issue in some of these transactions, particularly when, like you said, if you're a closely held business and you've probably been operating off of QuickBooks or something like that for far longer than you should have. But when a buyer comes in, one of the first things that you're going to exchange is financial information. So you do want to make sure that your books and your records are prepared in a way. It doesn't necessarily have to be GAAP, but I mean, certainly GAAP is a standard that is often used in transactions. But you want to make, you want them to be prepared in a way that the buyer can, get a good feel for what the financial status of the company is. And again, depending upon how you've handled your record keeping and your finances prior to that, will impact how difficult the task that is. And the other thing to keep in mind is, in most transactions, whether it's a stock transaction or an asset transaction, the buyer is going to want some sort of representation about, the financials that you gave them, that they're accurate and that they reflect the true status of the business. So you, as the seller, are going to be making a representation that, yeah, what I gave you is true, basically. So you do want it to be true.
And so I'm kind of interested in both of your thoughts on the next question, but so in terms of what skeletons there might be in your closet that you need to take a look at. So I'm gonna just ask Rob first, what might you say to clients? Okay, we kind of need to look at this, but I want to hear both of you on this topic.
Sure, and I'll react to Mike's comments as well. Those financials, I say to owners, those financials need to tell the real story and speak for themselves. You're not, Mr. or Mrs. Business Owner, going to be in a position to say, let me explain that line and let me tell you more about my chart of accounts, what's really going on here. You don't have an opportunity to explain. Those financials need to be presented in a way that they tell the entire story without your narrative, that they come off the page. So I think that is significant. Regarding the skeletons, yeah, this is the time prior to presenting financials to have those discussions about, my son is my janitor, so I put gas in his car. Okay, let's talk about that a little more, because closely held business owners over time just evolve to doing some things that perhaps they should not be doing or reflecting in those financials at the time that you're posturing for a sale. So said differently, let's make the unspoken spoken. And clearly, when a transaction takes place and it's I'll use the example, some multiple or multiplier of EBITDA, for example, I mean, $100 could become $500, or $100,000 could be $500,000, either benefit to the buyer or the seller. So the magnifier is significant, and the importance of getting it right is clear.
And so before you say, I'm going to just add a little to that question, since we've stayed on the financials. Is it beneficial to the client to actually have a business appraisal, or does that overly pin them down? Should they be looking at that, having some kind of valuation information done before, or do they get the financials in order to present that to the seller and let them make an offer?
I have experience and multiple examples to respond to that. However, could I pass to Mike? I would be interested in his perspective.
That is a good question. I think from the seller's perspective, I think you can do it in a way that it gives the seller an idea of what the value of the company is without necessarily binding them to that going forward. I think a lot of buyers will want that comfort just to make sure, a lot of sellers will want that comfort just to make sure that they're, what is being proposed as a purchase price is something that's reasonable. I think every business owner probably has a pretty good idea of what their business is worth. And in their mind, they have the exact idea of what their business is worth, but that may not always be the case. So I think the valuation can be an important part for the sellers, and whether or not that binds a buyer or whether or not that binds the seller to that particular price. I've seen it where that's been used, but I don't know that outweighs the benefit of it, I guess, would be my position on it.
But this is kind of a comment in relation to a business that I worked with last year. We had a lot of clients sell, right? And we had a lot of venture capitalists throwing just tons of money at whatever. It was a really interesting phenomenon. So we had a client who had actually had a valuation done by an investment banker, and a few months later sells the company for 3 times the amount the investment banker quoted. So in my mind, some of the challenge of having the valuation done is that the seller can sometimes have it undervalued or overvalued, and it sets a little other expectation. So who should actually conduct that valuation? Does that matter?
Yeah, if I could react, depending on the time horizon, if the owner says, I want to be done in the next year, that's rapid. If they are approached by a third-party suitor, that could be rapid as well. To Mike's response, I feel strongly if we have some time, a year or 2 or 3, where the owner is suggesting I want to be done, I really like, Mary, just a range of value. And I don't mean just like it's inaccurate. I like the range of value so that we can start planning for this legacy and perhaps some charitable income planning, deal structure, tax planning, that range of value. But oftentimes, as I mentioned earlier, lining up the financial, I'm ready to be done, with the emotional, I'm ready to be done. That financial aspect, I think the range of value is significant. To actually formally value the business, I feel like that needs to be done much closer to the transaction, and then oftentimes would be a discussion with a potential buyer. If we were speaking to the business owner, as I know we are, again, I like range of value as a stepping off point for planning.
And it seems like the potential value of during an early valuation, if we have plan ahead time, is that in looking at that valuation, you can look at what strategies you can employ to improve that valuation prior to sell, correct? So if you've been paying 5 kids on your payroll, and certainly those are adjusted when you're doing the calculations, right? But at the end of the day, you can clean some of that stuff up, or you can evaluate dropping some product lines that aren't really profitable, or expanding or developing some vision that's going to help make the business more attractive to a buyer. Mike, did you have any different or additional thoughts on?
No, I think Rob's point on the range, particularly when you've got some lead time on a transaction, is spot on. I mean, that certainly helps give the business owner an idea of where things are at, but doesn't necessarily, at least you hope, doesn't particularly lock them in on a value that they have to have one way or the other.
And so then I'm going to go back to my skeleton question, because one of the things is when you're selling a business, you do marketing and hype, here's all the great stuff about it. But the fact is, sometimes there are things that are going to be problematic for a potential buyer. What types of things might be, and I'm just using the word skeletons, in terms of looking at the business and saying, oh, this is going to really detract from the selling potential of it? What type of things might come up, Mike?
Well, there are a lot of different things that can come up. I know business owners always want to highlight the good things of the business and sort of downplay the bad. But unfortunately, in the transactional process, those bad things are gonna come out. So some of the typical things that you're going to want to kind of look at is, and it does depend on the structure of the transaction, whether you're doing a stock deal or whether you're doing an asset deal. But just generally overall, you're going to look at, geez, have I been paying taxes on time? Are there any outstanding audits that might impact a future purchaser? Do I have any environmental issues that I need to address, or that are in process, or that I'm dealing with, or that could be something that a potential buyer is going to have to deal with. What employee situations do I have? Am I involved in any lawsuits, any equal employment opportunity issues? Do I have employee plans? Have they been funded properly? Are all those liabilities in order? So there's a variety of things that you need to look at when you're sort of doing, when the business owner is doing their due diligence on their end of the transaction, getting ready for it. Because again, those things are going to come up. You may have a contract that's material to you, and is that a contract that's going to continue once you're no longer around? Those are things that you're going to have to look at and address with the potential suitor to your company. And again, you're like the financials, you're going to be making certain representations and warranties in that agreement about all of those things. So you do need to have your arms around what is and is not out there.
And Rob's talked a lot about having everybody think about, having a business owner think about, okay, what am I going to do afterwards? So as part of that, what types of agreements might a seller ask a buyer to engage in? I mean, they should be thinking, in addition to skeletons and what Rob's talking about, what kind of income, is it possible, Rob, that the buyer might want the client to stay involved in the business thereafter? Should we be thinking about those things in the, or, should we be thinking about like a non-compete? What if our guy does want to go buy another business in the same business? So is there kind of a bullet point list of the things that should be considered in that regard?
Sure. If the business owner is going to be done following the transaction, have no further involvement, then you absolutely would anticipate non-compete agreement would be part of that, as well as non-solicitation, essentially leaving the current customers and relationships alone. You bring up a great point. If the owner does have some interest in continuing, then I would encourage, at some capacity or level, then I would encourage the owner seller to at least approach or address that in a potential transaction where their role may change a little bit. However, they can continue involvement in working with the new owner. Certainly, again, if that's part of their desire, we would sure encourage them to voice that, because we could make it part of the deal structure or proposed deal structure.
And that proposed deal structure, using some of those items, also have some tax benefits potentially, right, Mike? When you structure it, is that something that you look at in transaction design?
Sure. When you're selling your business, if you, let's say you've determined what the overall package of consideration is going to be, how you divide up that package can definitely have tax impacts. For example, the purchaser of your business may want to park part of that consideration or use part of that consideration for an employment agreement where you're going to continue to provide consulting services or other ongoing services to the purchaser as they transition the business. And the reason that the purchaser might like that is because they get to deduct that. So they take part of their consideration and they make it into a deductible expense. So there are those types of things that you're definitely going to want to look at as far as structuring the transaction.
And I'm going to shift to like one of my favorite topics, which is having the client look at the estate planning piece and what they can do from an estate tax perspective and an ongoing income perspective potentially as part of the process. So one of the things we look at, start with, let's look at the tax structure, tax efficiency, have the conversations about the legacy planning that Rob has mentioned. And then we look at some of the structures that can be used. And as selling the business, there's a variety of ways to do it. You can do an asset sale, you can do a stock sale. And I'm not going to go with this. We should probably do another episode where we're just discussing those strategies. Some people will look at an ESOP, things like that. But in terms of, let's just say for simplicity that I own shares in a C corporation, what would be my estate planning options to take a look at?
Well, again, prior planning is always the best planning. So if you're forward thinking enough, I mean, it can be as simple as making gifts of your shares to either other family members or or certain vehicles that you could use, like a family limited liability company, where you're transferring assets basically out of your estate. So when the payoff comes, when the business is sold, the income is coming in, or the gain is recognized by people other than you, or in a lower tax bracket, hopefully.
So that's a tax bracket shift, right? And then there's estate tax shift. So one of the common pre-sale strategies is a GRAT. Can you just briefly explain what a GRAT is?
Yeah. So if you're, and this can be particularly useful if you're, you're anticipating a sale and the value is going to be, going up appreciably from the time that you do the GRAT. So a GRAT is an acronym, just grantor retained annuity trust. But the gist of the GRAT is you are transferring a portion or all of the business into a trust. And when you do that, you're taking back the right to get an annuity payment from that trust as payment for the assets that you're putting into it. So I put my stock into it, that's worth $100. I get back an annuity that's worth $100. And that annuity might be payable over 1 to relatively short term, normally in this type of lending. So you may be asking, okay, well, how am I saving any taxes by doing that? Because I gave away $100, but I get $100 back. Well, the idea is that when you give it away at $100 and you take $100 back, when you go to the sale transaction, the purchaser comes in and says it's worth $200. So I've given away something now that's worth $200. I only got $100 back. So the $100 in appreciation is outside of my estate. It's to whoever the beneficiaries of that GRAT are.
And another strategy that we've used in recent years relates more to state income taxes, right? And that is the intentional non-grantor trust. And that is, for example, they have different acronyms, right? It's a NING if you create a Nevada intentionally non-grantor trust. It's a SING if it's in South Dakota. It's a DING if it's in Delaware. And so the goals of those acronyms, there's some states you can create in there, is if you're in a high income state, let's say I think California is what, 13.3% or something like that. And some of the West Coast states have super high income tax rates. The concept is that you'll take that company, put it in, you create a Nevada, for example. So Nevada has no state income tax. South Dakota has no state income tax. If you're in a position where you can create a trust, drop the assets into there, you're still paying federal income tax in such trust, right? But what you're doing is avoiding state income tax. So we're always kind of looking at 3 different strategies. We look at the estate tax strategy. The GRAT is more on the estate tax side. The ING is a little bit more on the state income tax side, but is also a long-term state income tax too, because if you leave the assets in that, and you can always decant them to another trust. Did you have any different thoughts on structures, Rob, that you've liked or seen?
You certainly have covered it, I think, at this time. So no, I don't have anything to add related to the structure. Using in the state planning world, I will mention in the income tax planning world, again, perhaps it might make sense for an owner to, as much as possible, to extend when that income is hitting their 1040. So as mentioned previously, perhaps they do sell a portion or percentage of the company initially, stay on board for a period of time, and then sell the other percentage ownership sometime later. That not only would emotionally keep them connected, but financially that might make some sense to defer or really push out that income tax burden.
Just to follow up on that, often one of the forms of transaction is a promissory note that stretches that payout over a period of time. And by using that sort of installment sale, you can also stretch out the payment of the tax, which is another way to, instead of just getting a lump sum in year one and you pay all your tax in year one, take a 5-year note, you get paid out over 5 years, and you get to spread that tax over 5 years instead of paying it all at once. Now, there's always risk associated with taking a note. Will the company be around in 5 years? Will they be able to make the payments? It's nice to have that cash up front, but if you're fairly secure about those things, that can be a good way to sort of spread out that tax too.
And another thing we typically discuss with clients considering an exit is whether they have any charitable interest, because that's another strategy that can be used as they exit to save taxes. So can you speak to that, Mike? What strategies might you use in that regard?
Sure. There's a couple of different vehicles that are available, but the concept is the same. It's similar to a grant where you're going to make a gift to what we call a charitable remainder trust, and or you're gonna make a gift to the charitable remainder trust. You will get a charitable income tax deduction when you do that, if the trust is structured properly. And usually what you're doing is you're paying to the charity an amount every year, whether an annuity amount, a fixed amount, or whether it's based on the value of the assets of the trust. But you're making a payment every year to the charity based on the value of the gift that you make to this trust. And then once those payments are done, whatever's left over then goes to the beneficiaries of that trust, which could be your children or whoever it might be. So again, the idea is that when you put it in, it's worth something, and your annuity payments are based on the payments are based on what it is when you put it in, but you're hoping that it grows in value over time. And then, or for example, if you have a sale event, that they pay more for the asset than when you put in, or when you put it in, and then that excess appreciation is out of your estate and it's to the beneficiaries of that trust.
And so, Rob, I really kind of like your legacy planning approach and thoughts, and would like to actually finish with any last comments you might have on that for business owners considering an exit.
Sure. Thinking about what has been discussed today, we have been a bit technical at times. I would just highly encourage the business owner to think more generally about that. You mentioned legacy, as I had referenced, about what their legacy might be, not only financially, but also what other aspects of their life and what's important to them they'd like to pass to next generation. Also, as Mike was talking about some of the techniques with charitable, if you have charitable intent, let's talk about and discuss that generally. Almost the blank slate. If you were to describe or define what your utopia might look like for your family and for your business and for your estate and for your charitable or philanthropy, why don't we start there? And then we as professionals can work to hopefully effectuate those wishes. So just a high level of encouragement here for business owners to not always get bogged down in the technical, yet recognize that you need to be surrounded with professionals.
Well, Rob and Mike, I really appreciate your participation in this episode today. So that'll be all for today, and we'll be back with more information in a follow-up episode. Thank you.
Thanks, Mary. Thanks, Rob.
Take care.